In 2019, central banks around the world quietly dismantled a decade-old agreement limiting gold sales. Why? Because they had become some of the biggest gold buyers in the world. Now, 5 years later, gold has shattered historical records and is on its way to do even more. But what is the role of central banks around the world in the story of gold's ascension, and what role will they play in the coming years? If you want the stories about precious metals you won't find anywhere else, hit that subscribe button to support the channel and get new videos every week. Central banks are the institutions responsible for managing a country's currency, reserves, and financial policies. They hold large amounts of assets, including gold, as part of those reserves. When they buy or sell gold, it has a direct impact on global prices because of the sheer scale of their transactions. Central banks have been stockpiling gold for years, giving spot gold prices momentum, but it wasn't always like this. In the 90s and early 2000s, central banks were net sellers of the precious metal. For years, they pushed gold out of their reserves, placing greater reliance on foreign currencies. To ensure the gold market remained stable amid selling pressure from central banks, a global agreement was enacted called the Central Bank Gold Agreement. This agreement limited gold sales to a specific structure to avoid negatively impacting the price of gold. In 2008, changed everything. With the collapse of Lehman Brothers and hundreds of other banks, the global financial system was at real risk of a complete failure. Central banks awoke to the inherent dangers of a globalized society where everything is more connected, more complicated, and ever more fragile. Foreign currencies no longer seemed a suitable enough hedge. Suddenly, gold was no longer an afterthought, and the accumulation phase began. By the time 2019 came around, central banks no longer had any need for an agreement to limit the sales of gold. After all, no one was selling. The Central Bank Gold Agreement was dissolved through an act of non-renewal. And following the events of 2020, a global pandemic which led to unprecedented stimulus and rampant inflation in the world's leading economies, gold demand has accelerated. Central banks have been buying gold at a record rate, showing little sign of slowing down. The world, it appears, is in need of stability. Each year, the World Gold Council surveys central bankers and releases the results to the public. We learn a lot from this survey. For example, we've learned that 32% of the central banks in 2024 now factor in de-dollarization when considering how much gold to hold. This is up from 18% in the 2022 survey. When we look at the 2023 survey, we saw that only 27% of advanced countries felt that holding gold as an inflation hedge was a highly relevant factor to holding gold. But in 2024, that number has increased to 83%. We can also see that central banks have grown more concerned about systemic financial risk and political risk over the last 12 months. And in the coming 12 months, 29% of central bankers expect to increase their gold holdings, the highest rate since 2018. Analysts expect gold to reach $3,000 per ounce in the near future. If not by the end of 2024, then sometime in 2025. We could be a mere few months away from another new record. And there is no doubt the purchasing habits of central banks have a role to play in these analyses. As a result, any fizzle in the gold purchases by central banks is watched closely because of this. The People's Bank of China was the largest buyer of gold in 2023, increasing their gold purchases by 30% over the prior year. Their aggressive gold purchases are believed to be due to a multitude of factors, including their de-dollarization initiative, a hedge against U.S. debt default risk, and as a tool to handle potential future sanctions. But in 2024, the People's Bank of China allegedly paused gold purchases, with no changes reported to their gold reserves starting in May. The gold boycott from China has continued through September, yet gold prices have continued rising throughout this period. While official reports show no increase in reserves from May to September 2024, some analysts suggest this could be a cover for continued, undisclosed acquisitions. China has a history of negotiating secret agreements to acquire gold and silver in large quantities. In 2009, China announced they had purchased 454 tons of gold in a series of purchases that began in 2003. And again, in June of 2016, China announced they had purchased another 604 tons of gold, acquired between 2009 and 2015. And even today, China has built an entire secretive supply chain to source silver from mines around the world, shipping the ore directly to refineries to be processed into fine silver, bypassing the exchanges that determine prices. The reason for all this secrecy is twofold. First, if your political adversaries don't know what you're doing, they can't stop you from doing it. Second, by making purchases in secret and avoiding official channels, you can sometimes mute the impact your purchases have on prices, allowing you to acquire more at a lower price. Considering China's history, it's plausible they are purchasing gold through other channels that preclude the need to report official central bank holdings. Businesses the Chinese government owns may buy gold, the Chinese military may hold gold, and Chinese sovereign investment funds could also all own gold. Chinese gold mines all send their gold to the government. One analyst reports that China has purchased at least an additional 400 tons of gold this year covertly, though it is difficult to confirm these findings. And this highlights why there is a lack of concern about China's central bank absenteeism over the last 5 months in the gold market. They may be continuing to purchase after all, and it's expected other central banks will continue to purchase as well. As inflation continues to erode the value of currencies worldwide, the real value of currency reserves declines. Central banks often aim to maintain gold as a set percentage of their total reserves to safeguard against such risks. For example, if a central bank wants to keep gold at 10% of its reserves but sees the value of its currency holdings fall due to inflation, it needs to buy more gold to keep that balance intact. Even if there are political reasons not to increase their gold holdings, central banks may find themselves buying gold simply to maintain the status quo. All this points to a future where central banks not only continue to acquire gold, but also drive its price to unprecedented heights, reinforcing gold's role as a cornerstone of global financial stability. And that's all we have for you today. Please remember to like, subscribe, share with a friend. Thanks for watching, and we'll see you next time.